Hello, welcome to latest wealth online classes. I am Kailash here, financial advisor as well as wealth coach. My dear friends, in online classes, in earlier episode you learned about basics of analysis. What is technical analysis? What is fundamental analysis? Now let us learn about introduction to technical analysis. My dear friends, now just you understand briefly what is meant by technical analysis in earlier episode. Here in this class, we are going to focus more into a little bit deep and assumptions of technical analysis. First is application on asset types. You know one thing, the greatest versatile feature of technical analysis is that you can apply technical analysis on any asset class like stocks, futures and options and commodity trading, because wherever you are getting historical time series data. Time series data in technical analysis context is, that means it is the information pertaining to price variables, namely open, high, low, close and volumes, etc. I will give you an idea so that you can understand better. Just you think about learning how to drive a car. Once you learn how to drive a car, you can literally drive any type of car, correct now? Same the way, once you learn technical analysis, you can start applying the technical analysis in anywhere. Please understand, when you are learning driving, initially it looks like a confusion thing. One side gears, shifting, you have to handle the steering, you have to change the gears, you have to clutch, brake, accelerator, rear view mirror, all these things. But after some time it will become easy. Once you learn the driving, you can drive in any city. Same the way, once you learn the technical analysis, you can apply in any asset class like equities, commodities, foreign exchange, fixed income, etc. This is probably one of the biggest advantages of technical analysis when compared to other fields of study. For example, suppose you learn fundamental analysis of equity, and when it comes to fundamental analysis, you have to study about profit, loss, balance sheet, cash flow statements. However, fundamental analysis for commodities is completely different. Suppose if you are dealing with agriculture commodity like coffee, pepper, then the fundamental analysis includes analyzing rainfall, harvest, demand, supply, inventory. However, fundamental analysis of metal commodities are different. So, same the way for energy field, it is entirely different. So, every time you choose commodity, the fundamental analysis type changes. However, the concept of technical analysis will remain the same irrespective of the assets you are studying. For example, an indicator such as a moving average, convergence and divergence, MACD, or relative strength index, RSI, is used exactly same way on equity, commodity or currency. So here what happened? 3-4 birds at one shot. Now let us go to assumptions in technical analysis. What are the assumptions in technical analysis? See, it is not like a just fundamental analysis. The technical analysis don't care where the stock is undervalued or overvalued. In fact, only thing that matters in stock past trading data, price and volume, and what information this data can provide about the future movement in the security. My dear friends, technical analysis is based on very few key assumptions. One needs to be aware of these assumptions to ensure the best results. First assumption is 1. Markets discount everything. That means these assumptions says us that all known and unknown information in the public domain is reflected in latest stock price. Whatever fundamentals of the company, whatever the company management, what product they are selling, what is the demanded product, whether future is there or not, everything reflects in the stock price. For example, there could be insider in the company buying the company stock in large quantity in anticipation of good quarterly earnings announced. So what happened? When he does Secretly, the price reacts to his action because thus revealing to the technical analyst this could be good buy. Second, second assumption is how is more important than why. This is an extension to the first assumption. Going with the same example as discussed above, technical analyst would not interested in questioning why the insider bought the stock as long as he knows how the price reacted to the insider action. 3. Price moves in trend. All major moves in the stock market an outcome of trend. The concept of trend is foundation of technical analysis. For example, the recent upward movement in Nifty index is 7,700 from 6,400 did not happen overnight. This move happened in a phased manner over 11 months. Another way to look at it is once the trend is established, the price moves in the direction of the trend. Fourth assumption is history tends to repeat itself. In the technical analysis context, the price trend tends to repeat itself. This happens because the market participants consistently react to the price movements in a remarkably similar way. Each and every time the price moves in a certain direction. For example, in uptrending markets, market participants get greedy and want to buy irrespective of the high price. Likewise, in a downtrend, market participants want to sell irrespective of the low and unattractive prices. This human reaction ensures that the price history repeats itself. Now let's go into one more topic called trade summary. Let me remind you, my friends, of course this may change in future, we don't know exactly, but at this present moment, the Indian stock market opens from 9:15 a.m. to 15:30 p.m. During the 6 hours 15 minutes market session, there are millions of trades that take place. Think about individual stock. Every minute there is a trade that gets executed on the exchange. The question is, as a market participant, do we need to keep the track of all different price points at which trade is executed? To illustrate further, let us consider this imaginary stock, which there are many trades. Look at the picture below. Each point refers to the trade being executed at a particular time. If one manages to plot a graph which includes every second from 9:15 a.m. to 15:30 p.m., the graph will be cluttered with many points. Hence, in the chart, for the ease of understanding, we have plotted a limited time scale period. The market opened at 9:15 a.m. and closed at 15:30 p.m., during which there are many trades. It will be practically impossible to track all these different price points. In fact, what one needs is summary of trading action and not really the details on all the different points. By tracking open, high, low and close, we can draw a summary of the price action. The open means when the markets open for trading, the first place at which trade executes is called opening price. The high, this represents the highest price at which the market participants were willing to transact for the given day. The low, this represents the lowest level at which the market participants were willing to transact for the given day. The close price is the most important price because it is the final price at which the market closed for a particular period of time. The close serves as an indicator for the intraday strength. If the close is higher than the open, then it is considered as a positive day. Otherwise, it will be treated as negative. Of course, we'll deal with this in a greater detail as we progress through the module. The closing price also shows that market sentiment and serves as a reference point for the next day's trading. For these reasons, closing price is more important than the open, high or low prices. Actually, the open, high, low, close. Prices are the main data points from the technical analysis point of view. Each of these prices have to be plotted on the chart and analyzed. Let's revise what we learned. 1. Technical analysis is not bound by its scope. The concepts of technical analysis can be applied across any asset class as long as it has time series data. 2. Technical analysis is based on few core assumptions. The assumptions are: A. Market discounts everything. B. The how is more important than why. C. Price moves in trends. D. History tends to repeat itself. Now the third assumption is a good way to summarize the daily trading action by making the open, high, low and close prices, usually abbreviated as OHLC. My dear friends, hope you have enjoyed this learning. We are going step by step, and don't be in a hurry. Learn step by step. Watch once again, understand very clearly, watch once again with concentration, because foundation is very, very important. Please remember, enjoy the process. More you enjoy the process, more results you are going to get. Enjoy the life, be wealthy. Let's meet in next class. Thank you. Till we meet again, enjoy every bit of life. Have a nice day and bye bye.